Thank you both for joining us. You know, the Journal has an interesting piece just about how we're looking at this sort of very strange economy and even maybe stranger market where you've got, you know, profits holding up of sorts against a sort of fascinating revenue picture. And yet the markets have continued to go up, and people, I think, are sort of thinking, what's going on here? I'm sorry, I should say not profits holding up, margin compression at a time when the markets are going up. So what do you think is happening here, Mimi?
Well, I think that there is a bit of a tug of war here. We see the earnings as not so great, as you pointed out, and margins compression is continuing. On the other side, I think some of what was giving markets the optimistic view into the start of the year was the China reopening story, and also a potential to maybe have a soft landing, I think got some folks geared up.
Zach?
You know, Andrew, I see it a little bit differently. I mean, you know, I think actually earnings have been pretty good by and large. And when you talk about, you know, that story in the Journal, which I haven't read, but I've seen similar things, you know, talking to that theme. And I think that's just part and parcel for the situation that we have today, where, you know, volatility is elevated in the real economy because we have high inflation. And so there's a difference between nominal and real growth. You know, we saw that last year with the GDP print, and we're seeing it again this year. And so, you know, I think broadly speaking, we're kind of looking through some of this in the short term, and just really as we assess the health of the U.S. economy, to us, it looks pretty strong. And so we think that's going to feed through into corporate profits, whether it's this quarter or the next one is a little bit less relevant than the kind of the bigger picture in our view.
If you're right, what are you doing about it?
Well, if we're right, I think that means that, you know, equities have a little bit of a room to run here. And so, you know, we have been increasing our risk exposure across our portfolios in the last couple of months. But that does kind of set up a situation potentially in the, you know, in the summer months or maybe in the fall, because you look at the Fed's projections and you look at the way that they're thinking about things, they're really relying on a slowing economy to do a lot of their work for them. And so we could be in a position where, you know, we don't think the Fed is behind the curve right now. But if they, you know, kind of guide things a little bit slower in the next few months, we could be in a situation where we don't have to, we're not talking about, you know, 5.25 terminal rates. We're talking about maybe 6% rates. And certainly at 18.5 times forward earnings, the S&P is not priced for that.
Mimi?
Well, we came into the year squarely neutral, so we're in a pretty good position right here. We've been enjoying the upside that we've seen thus far, and we're getting a bit more cautious on equity evaluations right here. But having said that, we're looking for a broad range trade in the S&P over the course of the year. Call it 3650 to 4300. And on the fixed income side, we're really enjoying some higher yields and picking some points. Like emerging market debt is yielding close to 7%. Front end tips they've just moved quite a bit. We've been long them for some time, but we expect them to continue to provide protection. And just overall, we're looking for a 10-year yield range of, call it 3.5 to 4.25%, and we're happy to earn the yield on the fixed income side.